Structuring 2.0 means aligning three very important P's: purpose, people, and the process before scaling. Up next is the topic that matters the most to any entrepreneur in this room: structuring Startup 2.0. It's about building foundation so firm that they can let you sprint without tripping. Here are some facts and trivia before we start. So, despite having 1,59,000 startups now recognized under the Startup India, only 12% of total funding in 2023 went to early age startup ventures. Investment remains highly concentrated in metro cities. Selected in sectors, only 6% of startups were funded between 2014 to 2020. What this tells us: the right structure, strategy for early age funding, talent access, and equitable investment are pivotal for resilient startup. On that note, I would like to invest the speakers for our next session. Ladies and gentlemen, let's welcome Mr. Mandeep Mehta, Group CFO, Policybazaar, scaling one of the India's most successful digital first companies through IPO Readiness. Mr. Shivinder Sharma, CFO, Clove Dental, expert in healthcare business, structuring and group capital management. Mr. Ashish Kumar, CFO, Stanza Living, driving financial strategy in one of the India's fastest growing alternative housing startup. Mr. Gaurav Chaudhary, AVP, FLPA, Cardeco Group, managing capital strategy and financial planning in India's auto tech space. For this panel, we have a moderator, CA Gaurav Sukreja, partner and national leader, advisory, Kirtan and Pandit, guiding financial structuring for fast growth companies. With that, we have all the panelists here. I would ask and I would like to request everyone, please be seated and let's start the panel discussion.
Hello.
So, sir, over to you.
Thank you very much. And first, I would like to thank IIT Delhi for planning this wonderful event. Special thanks to Gaurav ji, the CFO of IIT Delhi. And, we have a wonderful panel here and we already have a lot of clapping happening from the god. Indradev is happy with the panel sitting here. So, let's welcome our panel with a round of applause. See, our topic today is structuring startup 2.0, capital, ESOPs and IPO. Startups start, but they fade away over a period of time. So, what we learn from a lot of companies, a lot of startups over a period of time is that how startups have raised funds. What were the first few issues which the startups had in raising funds and having problem? Now, I have on my right the first panelist, who is Gaurav Chaudhary. He's group head FP&A at Cardeco. You've seen company evolve from a car marketplace to ideally insurance decode. One dilemma every founder faces is choosing the right investor. From your experience, what actually works? Is it the personal connect? Is it the warm references? Or even a well-crafted cold approach could also help. So my simple question is, how should startup think about building the right investor relationship across different stages? So off to Gaurav. Thank you.
Thank you, Gaurav, for the question. So firstly, thank you for having me here. I'm very happy to be here. Actually, I admire IIT Delhi. And it's also special because my founders are from IIT Delhi. So I have a personal connection with this place. So coming to your question, Gaurav, I think the dilemma that you are talking about is really very common in all startups, right? So I'm sure every founder would actually go through this journey of finding an investor, and therefore, as you rightly pointed out, that what is the approach that one should follow for getting the investors on board. I think everything works, right? Whether it is references or it is personal connect or it is, let's say, cold outreach, right? What matters is that you should actually think of it as the stage you are in the journey, right? So it depends on what stage your startup is right now. So if it's a seed stage, it's about person and vision, right? So in the seed stage, in my view, uh, numbers matter less. I think the person matters more, right? And therefore, the conversations that you have with your investors should be very transparent and honest in this, importantly in this phase, right? As you move ahead, you enter growth phase, right? Let's say seed B to seed D, and therefore this is again very important phase. Now, in this phase, the focus shifts from growth to, let's say, governance and scalability, right? And therefore, what you should be caring about is, as your startup is evolving, you should actually change your narrative. So the focus shifts from chasing revenue to improving EBITDA, and then finally to generating cash flows. Third comes the late stage, or let's say pre-IPO stage. Now in this stage, it's all about earning trust through credibility, right? Now, how do you do that? I have a friend in VC fund who always tells me that, you know, I would rather go for a founder who delivers 95% of forecast rather than a person who promises to the entire world and delivers 50%. So delivery becomes very important. A public investor will not buy a hockey stick, let's say in year 5. Rather, they would want that you perform consistently over next 8 or 10 quarters. So that's what they'll expect from you. And therefore, if I put it like this, that, you know, the doors can be opened through personal connect, or cold outreach, or warm introductions, but the doors will remain open only if you win trust through credibility, consistency, and predictability.
Thank you very much, Gaurav. Can we have a round of applause for the response, please? You know, it's a wonderful thing that it doesn't matter whether it is a warm reference or is it a cold call. It's about the credibility that you have built in the industry. That makes all the difference. So thanks a lot for this anecdote. We have next question for Shivinder. Shivinder, your career spans across transformation-focused finance roles. From Nike to Bira to Del Monte and Lahori Zira, to leading Clove Dental at this moment of time, India's largest dental network operating over 600 clinics and serving 1.5 million patients. You have always led leaders, and hence your investors and backers have also been the same, like Qatar Institutional Authority. How has your investor reporting evolved? You know, it's more important that once you get the investor, you have to keep reporting to the investors as well. So how has it evolved both in frequency, that is quarterly, half-yearly, maybe fortnightly, in the kind of information you share? And since you have worked with VCs, PEs, and now institutional investor, what key metrics do each of them really chase? And how do you balance them all? And, you know, simple question is, does the information flow increases when you go up the ladder, or does it go down when you go up the ladder? So off to you, Mr. Shivinder. Thank you.
Hi. Before I answer this question, a couple of things I want to know from the audience. How many of you are invested in the stock market? Could you please raise hands? Okay, great. How many of you are aware of the terms EBITDA, cash flow, profit and loss? Super. So before I even answer one question, and there were a couple of questions from him, let's take a very simple analogy. When you invest in the stock market, hand to your heart, how many times do you check your account in a day? Every day? A week? A month? Hands up for those who look at your stock investment every day. Okay. How many of you look at it? How many of you look at it every week? How many of you look at it every month? जैसे आप रिस्पॉन्स दोगे फिर मेरा आंसर भी वैसे ही आएगा. So you need to be very honest with yourself. Thumb rule is, when you invest as an individual, invariably once a day, once a week, you always check on your investment. Correct? You always have doubts in terms कि यार मेरा शेयर नहीं बढ़ रहा, किसी और का बढ़ रहा है. Should I reinvest? The stock is coming low. Should I put in more money, etc., etc. Now you take this up 10,000 feet. There is an investor who has come to your door. You've convinced him through various presentations, PPTs, walk to the market, and in the end he's decided to lock in his funds with you, right? And those are not some chiller thousands, those are in the tune of a decent crores of rupees. So it's very, very logical to expect him to be your partner in this entire game. When your scale is small, he would get into all matters of operations because there's nothing else to do other than an Excel which shows him a path for 5 years. So his initial interaction with you is going to be very, very micro in the sense that he'd like to understand the picture. As the scale grows, all right, and I'm being very candid, as the scale grows, the polished versions of board deck, management presentations, it's just a change of words. What basically the investor is looking at, and when will he back off, is when he completely understands that your monthly, quarterly, yearly progress is in line with his long-term goals. He has put in the money for a long-term objective. He's not in here for the short run. So, to answer your question, Gaurav, as long as he's not getting that support, that confidence, that each of your step is working towards that ladder, he will remain invested in you and he will ask you more and more, right? Whether it is your monthly pack, whether it is your budget pack, he would want to understand market from a financial lens. So for a CFO, it's a dual task of understanding his business, going to leaders across the department, understanding what worked well, what didn't work well, and convert them into a financial language. What do we mean by that? You'll have to have both the depth and the width to make the investor understand your financials. Which category is working? Which city is working? What is the EBITDA margin for a product? What is the overall EBITDA margin? Where are we in terms of costs? Which costs are controllable? Which costs are to be invested today, but the benefit is going to be for a couple of years, right? Let me give you a small example. Gaurav just mentioned that we have some marquee investors. We recently logged in about $500 million as an investment, all right? Bulk of this investment is for scaling and bringing in new clinics. Mind you, we bring about 120 clinics every year. That's like 12 clinics or 10 clinics odd, which are operational. And fundamentally, there are about 18 clinics which are in the works, of which 10 a month get fructized and they start operating. Now imagine for me, I'm thinking as a CFO that my clinic typically takes between 8 to 10 months to break even, right? So on an average about 50, 60 clinics a year, on an average I'm thinking, what if I stop putting this clinic investment and I improve my bottom line? Well, that's intrinsically wrong, because it may dress up your financials very well, but it is doing wrong to the investor because he has invested in you keeping future in mind. So the investor works on both ways. He wants to understand the monthly profitability, but if you explain him well, he is willing to invest in spends which are heavy today, but which secure your future growth. The investor of today knows that the value doesn't come every quarter. It comes in a few years. But the bottom line wants to know is whether each quarter is laddering up to that success, laddering up to that number. All right? So Gaurav, the good news is the investors pull back. The bad news is that when they pull back with a lot of information from you. Yeah. So nothing changes.
Yeah, wonderful. No, thanks a lot. You know, your interaction was ideally very two-way. We got great response from the people, and we ideally got this, that our voice is going till the back. So that's very important. And you know, very rightly put that, you know, how people, when they look at losses coming on regular basis, think that we may stop doing this because every time I enter a new city, I enter a new geography, I'm not able to break even. There were a lot of startups like Milk Basket who did wonderful in Gurgaon, raised funds, did everything. But the moment they tried to step out of Gurgaon and move to Bangalore, they died. You know, now these kind of things, these kind of risk, investors also have to understand that how they are taking. They're working in one micro market, they enter into another, and wonderful example which you've given. You know, my next question from this to understanding from where the investors come in and what are the investors asking. One of the very intricate question which has always created a problem is that whether investors are pushing to go for an IPO. One of the listed company we have here is PB Fintech, having a market cap near to 1 lakh crore, around 80,000 crore, maybe more today, I don't know. Yeah, I don't check your market cap every day. So, but still there's so much to push. The company is still growing at a very high CAGR. It has the biggest market share in the organized insurance sector. And I wanted to understand from Mandeep, I've heard it a lot of times and I wanted to understand what is the right time for IPO? Is it a high growth stage or once stability sets in? And another, I have a follow-up question on this. Do investors push for IPO? And if yes, how do you not take that push? So, please.
Thank you, Gaurav. Well, it's really a difficult question, and I think you definitely reserved it for me. Well, practitioner point of view, when you should go for IPO? Never. Okay? But at the same time, let me tell you that if the capital market doesn't work, the capital growth or the capital generation in economy doesn't happen. It's very, very important that good businesses, good quality business come to the market, and the retail as well as institutional investor help in building this momentum. A lot of benefits because of this. But the problem is that the way the capital market has been structured and seen over decades and decades is for stable state businesses, right? Not for high growth companies. As Shavinder said, that he can be profitable next day, but he will have to cut down the growth, right? But when you see bigger companies, listed company, or rather, let's say a bigger high growth company in losses, the first question that comes to mind is, why should we invest in a loss-making company? The people who are familiar with finances will understand a bit in terms of what is unit economics, what is leverage, etc. But people at large will not understand, and this dilemma remains in mind that why other people are investing in a loss-making company, and we have faced those questions as well. Not too far back, I think about 2 years back, there was a momentum where all the investors started saying, show us the profit. To all the investee companies, right? So understanding that what is right for the business is very important. Number two, which Vinder also said, is that generally what happens, the business strategy and the value get determined by what your investors are asking for. If your investors are not supporting you in a high growth loss making business, then you will definitely curtail the growth and start showing profit. So it's basically a negotiation between investors and the founders or the business management saying that what we should do right now. And under pressure, probably you will slow down a bit. Imagine that this is happening with thousands of investors sitting out. And your stock is taking a hit, then you are confused in terms of what you should do, right? That's why I say that stock markets are for a bit of a stable state companies. And high growth companies, of course there are investors in that, and as we speak, I've been talking to various investors, and the momentum right now is the educated investors are searching for high growth companies, right? So that's why you see, the multiples, the value multiples, PE multiples. A point on that as well. If you look at the PE multiple of Zomato, us, or any high growth company, it is not comparable to any historical PE benchmark that you have set for yourself. Not even comparable to any PE benchmark of the market. Yet it is there. Now what will happen if we start making more profit? Value doesn't grow that much, the PE multiple start coming down. Now when you see an investment where PE multiple is coming down, is this a good investment or a bad investment?
It's subjective again.
Yeah. So what people understand, and that's why I say it's a very tricky question whether you should go for IPO or not. And my belief is that the high growth company go for IPO not for capital. Because capital is available through VCs, PEs, etc. There are a lot of investors, private investors, who come in and they go for liquidity, right? The stock become more liquid, and provide exit to investor as well as the management or ESOP pools, etc. Another indicator is if you monitor the OFS, offer for sale composition of the IPOs coming in, you will find at least 25 to 30% OFS. Yes. Right? So fresh capital generation is very less. So let's say that the hypothesis is that IPO is happening for provide liquidity to investors. Sometime founders, management and investor, they're all looking for liquidity. Everyone is happy, go do IPO, then only the finance and secretarial function will work. Will be little, not only work, I'll say, they will be the one who will feel the pressure of being listed. Everybody is happy, right? But when they are not aligned, when investor says something that they want an exit and the founder says they don't want an exit right now, or they think that the valuation cycle is not right up there, that's where the friction happens. And you will always see in the founders and the shareholder agreements, there is a clause which says exit clause or a IPO clause, something like that, right? Liquidation clause. And it will say that at a certain milestone, certain duration, investor has a right to ask for IPO or listing of the company on a best effort basis or reasonable basis, something like that, right? This is the clause which become, a point. But before going even to the clauses, because if you reach to the point of talking about clauses, your relationship is already broken. भाई लीगल डॉक्यूमेंट पे तब जाते हैं जब सब कुछ खत्म हो चुका होता है. बिल्कुल सही बात. Right? So even before going there is a conflict. The investor say exit, you say no, this valuation cycle is not right. It's a question of who convinces whom. Or IPO clause also have an alternative construct. It says that if not IPO, then this. Right? If not IPO, then this. Then those are the alternatives you have to provide. You have to provide, search for another investor, make a deal between the two investors, etc. Those are the things that you need to do. Yeah. But if you are stuck, then you have no other option, but you have to go for you have to go by the commitment that you give to the investor for a particular return. So that's where everything happens. But there is another thing which changes very drastically and which people realize after the IPO. Your decision making, your flexibility, the things that you could decide and say that don't have to tell anyone, now you have to go and tell to the public. Not only tell to the public, people judge also and give you a reaction in the stock price. Yeah. Right? So this change, people don't realize what is going to hit them when they're talking about IPO. IPO become a very fancy, glamorous word of saying hundreds of crores are made by this person, hundreds of crores are made by this person, and everybody says that I can also do it. But this is that life changes. You live quarter to quarter. Your long-term vision can get impacted, can get converted into a short-term vision, right? That's why choosing a point of IPO is very, very critical in your journey.
Thanks a lot, Mandeep ji. His insights on IPO has always been wonderful, and with all the positives and negatives of the IPO, it's obviously one of the dream of every company to be listed at the end of the life cycle that has been always there. Having capital is one thing. Second is replying back to the investors. Third is talking about the IPO. The most important thing in a company is the human resource. Ideally, all of us on the panel would agree to that. Now, the one most important way of retaining the employees is employee stock option plan. And there's so much questions around it. I'll take this question to Ashish ji. Ashish ji has been, last CFO at SpiceJet, wherein pilots are critical. Now he at Stanza Living, when in tech, real estate. We also have our CFO from Clove Dental, where doctors are so important. We have other companies where tech developers are so important. Now, a lot of entrepreneurs, I've taken a lot of sessions at IIT Delhi also, wherein there's a question that how much should be the pool? That's the one question. Second is, who should I offer the ESOPs to? The third is, what should be the vesting period? What should be the exercise period? And maybe for few people who are new to this sector, we would want to understand how do you see ESOPs as one tool which is helping the companies to retain? And what are the key areas which people should understand before finalizing the ESOP plan or ESOP policy? Ashish ji, please. Thanks a lot.
Thank you. So, see, technically, in a company, of course, we all know doctors are important, pilots important. In a startup company, retaining talent, ESOP is one of the plan. The main idea and the benefit of having an ESOP plan is that as an employee, I show up to the company, and as a ESOP owner, I show up as an owner of the company. It creates a lot of stickiness and ownership of the respective employee when they show up for the business. They take ownership in the plan, they take ownership in the performance, they take ownership on a daily basis, and that creates a great team and a great performance culture in the organization. And they believe that whatever they do, the fruits in the pudding, and that is something going to show up 2 years, 3 years, 5 years later. Now, having said that, a lot of companies we have seen that the ESOP pool is not good enough, so it just gets restricted to the CXOs. In my view, it should be that horizon should be more broadened, because ultimately, the team's middle management and of course the senior management, and there are certain critical resources. It will vary organization to organization. There's no certainly prescriptive approach that this much of percentage should go to CXO or the middle management or the junior management. Coming ideally in a ESOP pool, you should have enough between 8 to 12%, because you're not short of that pool ultimately when you go for an IPO. That's point number one. Secondly, you are trying to create a ownership structure, and let me tell you, all these ESOP are paper promises, because today all these whenever you invest in a listed company, आप 100 रुपये में खरीदे, आपको पता है 90 है तो चलो 10 का नुकसान है, 110 है तो 10 का मुनाफा है, लेकिन पेपर प्रॉमिस में पता ही नहीं. हमने एक विजन सेल किया है टू द इन्वेस्टर, एक विजन सेल किया है to the employees, a vision to the market that we have found a problem, we have solved the problem. Now, what is the potential of that stickiness with the employees and your growth plan? Somebody has to marry that plan, it has to perform, and it has to show, a performance. As he said, there's a lot of pressure quarter on quarter. I was a CFO of a listed company, I felt that pressure. Every quarter there's a pressure. Now, in this case, in order to create an ESOP pool, in my view, that you should have a proper ESOP plan and give them complete education and clarity. Because the tech guys mostly, and like in my company, it's a real estate tech enabled. We manage almost 50,000 beds. We intend to grow up to 5 lakh beds, and year on there's a growth. He's a highly voluminous in transaction. So tech is the only solution to manage the business as a whole. Now when you do that, you have to make sure that these paper promises are very clearly communicated and educated to the employees in terms of the value, in terms of the taxation, in terms of the percentage they get, and ultimately what is the exit plan. Most of the exit plan would be either through a divestment to a potential investor, either it will go through an IPO route, but the timings are very long term. Like at a stage when you take a seed capital, then of course you go through a series A, B, C, D, and then ultimately go for an IPO. How does that paper promises actually look like to be actually be fulfilled, that I can see money in my bank, and how can I see that, how easily I can get it? And technically a horizon of a divestment and an IPO, it will be varying between 5 to 10 years of the company. Employees may come, employees may go. You have to build a structure that, okay, if a guy is for a year or 2 year or 3 year, there has to be some sort of a plan for those employees always, because you cannot expect that employee joining for the first year will remain till the IPO, that is 8th or 10th year of the company. So that's not the horizon of every employee. So your clear communication, clear education, and a pool of 8 to 12% is the ideal structure, and that paper promise, somewhere you have to educate them very clearly that this is the value you get derived, this is the value is going to come, these are the potential 5 metrics basis on which, okay, we'll hit this revenue, this EBITDA, this market share, how do I stand with my peers, how does my peers who have listed, where do they stand, and how does these paper promises look like? So I think clearly, instead of showing too much that future is only, we fulfill this promise step 1, 2 and 3, and you are part of this journey. So I think in my sense that 8 to 12% of pool, a clear education and a communication, and enough sharing of that pool with the most of the critical talents across the organization. It would definitely vary company to company, but I think in my case that it should be covering according to the designations or in the role in the company. I think that should be fairly distributed where people feel a lot of ownership in this work for the work.
Mandeep would like to add something.
just to relate back to the previous question, ये paper promise ही रहता है जब तक आप listed नहीं होते, right? So everybody says कि ये तो बेकार है, हमारी सैलरी चल रही है, आएगा तो आएगा, नहीं आएगा तो पता नहीं, ये तो बोलते रहते हैं, promises होंगे नहीं होंगे. But the moment you get listed, people start to come to CFO office. आज सर 5% डाउन है, क्या हो गया? You know, this is like ownership that you will start building in. Every 2-3 percentage movement, they will try to figure out क्या हुआ, अब बेच दे क्या, अब एक्सरसाइज कर ले क्या, टैक्स का क्या होगा. They become so conscious, and that puts a reverse pressure on the management. That because now you see the promise get delivered in real time.
Absolutely. You know, a lot of time we have heard सैलरी से घर नहीं बनता. सुना ये वाला कहावत सुनी होगी. A lot of you would have heard that. सैलरी से घर नहीं बनते, दिल्ली शहर में नहीं बना पाओगे. Now, this is one of the most important wealth creation, which is the ESOPs. सैलरी में जो ESOP है, इससे लोगों के घर कमेलियास में बने. So that's very important on the ESOP point. That's how important it is. So we have to conclude the session very fast from now. So we'll have a small reel-based answers. 60 seconds, so that they can create the reels which IITians would understand, the Gen Zs would understand. I'll give one question to everyone and we'll just take 60 seconds and answer that. So, my first question is to Gaurav again. Gaurav, we're just talking about ESOPs. I wanted to understand from you, how can founder ensure fairness while keeping motivation high across the team? Now, there's problem that some people who enter the company, they are given ESOPs. Some who have stayed with the company for 10 years don't have ESOPs. Now, how do we help in doing that? Early stage, or maybe people who are there later hires. Yeah, please.
So I'll make it very short. So it's very simple. So if the company is in its very early stage, the allocation has to be very high. So you get a larger pie, the employees will get a larger pie, right? As the company grows, it gets stable, the pie will reduce, right? Because the certainty increases of getting cut, right? Now, couple of points that I think are important is, as Ashish mentioned, that the clarity should be there when you communicate to the employees that this is not just for retention, right? This is for building ownership in the organization. So it actually aligns the employees with the vision of the company as well as creates a sense of ownership in the organization, which is very important. Second, as Mandeep mentioned, that it is actually a lottery when it's not listed, right? So for companies who are not listed, people think that it's a lottery ticket. So to make it more realistic, what's important is that you do some liquidity events in between, do some buybacks, right, through some secondary, so that a portion of it can come back to employees as cash incentive, so that it becomes more realistic. And lastly, keep calibrated whether I think this is okay. Yeah. So the last point is that you keep calibrating your vesting schedule, do some top-ups, right? So that you evolve the ESOP structure as the company is evolving.
Hello. Yeah. So, like ESOP is Zerodha is $1 billion company. It's $1 billion by the ESOP buyback which they have done. It's not funded at all. It's an unfunded company altogether. They valued themselves $1 billion and bought back the shares. That's why they are valuing themselves. My next question is to Shivendra. I know you will check if that mic is working. What is the best practice CFO should adhere while managing relationship with investors and financial stakeholders?
Hello. Yeah, hi. So I'd say I'd use an acronym called BASIC. BASIC. B stands for building trust. The first thing that you must do with the investor is ensure that every information committed to them goes to them on time. It doesn't matter whether it goes to them in Excel, in PPT, in a Word document, but it goes on the day you promised. That's how you build trust. That's the first factor. Second factor, A. A stands for analysis. When you're
Giving information, it's not just about day-to-day management, P&L, telling about the month's operations. You must tie the financial metrics to the long-term vision. They must understand the bigger picture. They're not happy with the day-to-day appraisals or the month-on-month factors. S stands for storyteller. A finance guy, you have to have a cap of being a good storyteller. You need to tell what's happened in the market, right down to your basics in terms of either a category growth, a margin story, a success factor that happened in a particular city, hits and misses that you have in a particular state. Proactive about telling where is it that you see a risk, right? I stands for insights. What's an insight? Insight is the ability for you to go deep or wide. When I say deep, you should have 3 layers of information ready. If this category is not working, what in this category is not working? Why is it that it is not working in terms of either it's a margin issue or it's an issue in terms of introduction, pricing issue, etc. The more you're able to give him a deeper dive, the more he understands. C is for consistency. Please don't change your reporting formats every 3 months. That gives a very discontent feeling to the investor. You wouldn't like it if I were to change the reporting formats every 3 months. Whatever was your narrative when you met him first and showed him the 5-year vision, as much as possible, keep the same narrative. He's understood your AOP, he's bought in your AOP because you showed him something, he believed in it. Don't just please change it, right? And S stands for stakeholder feedback. It's not a one-way street, guys. You have to understand what he's saying. He sits on the board of many companies. He brings a utility, he brings a value that can be easily replicated. It doesn't matter whether it's an FMCG to a healthcare or a healthcare to a manufacturing. Please listen to him, understand his perspective, and try and see how best you can adjust. So my 60 seconds are over.
Thank you, Shivendra. Thanks a lot. You know, a wonderful anecdote on that. My next question is to Ashish ji. Ashish ji, you know, all of you are ideally CFO alongside your angel investors. I'm presuming your angel investors at various startups. For instance, at seed, Series A, Series B, by the time a company reaches IPO, what's a reasonable equity position for founder to still remain control? Like, for example, a lot of them ask me the first question, in the seed round, how much should I give? You know, that's the first problem every startup here sitting has it. By 10% de, 20% de, 5% de, what should I ideally give? Please, Ashish ji, off to you.
See, as I said again, there are a lot of emotions of founders on the paper promises, and you get stick to the valuation. In my view, the quality of growth which you are promising and the capital adequacy required for that, founders should not deter in diluting their stake. Of course, in the initial stage, when they start with the seed capital, anything between 20 to 30%. And then, of course, the series A, B, C, D, by the time it goes, they dilute almost 40 to 60%. And at an IPO stage, anything between 20 to 25% works. But having said that, I think the capital required for the business should have a good runway, because you never know that there could be some situation we are not able to manage, and you should raise capital when you don't need capital actually. That is most important, so that you are planning for all the eventualities. Because when you need money, and this raising capital, and I have been gone through this process recently, it takes at least 9 months to 12 months minimum if things are fine, and if you already have a credible investors on the cap table. So I think the founder should dilute depending upon the requirement of the capital, but at an IPO stage, you must have between 20 to 25%, and the dilution should gradually grow, but that dilution should happen in a manner where actually you have enough capital for the growth of the business. That shouldn't be compromised.
No, thanks a lot, and you've summarized it so well in 60 seconds. My next question is to Mandeep ji, and ideally the last on the panel. You know, you can ideally add to the question which I have already asked to Ashish ji, but I have a very important question for you. a lot of startups who are sitting here, the entrepreneurs who are sitting here, have a very basic problem. Can they negotiate the term sheet? Can they? Do they have the power to negotiate when they are at the seed level, when they are at the basic level? Are there any terms which they should say no to right away? And can they say no to right away? Or is it a deal breaker when a founder comes up to negotiating the term sheet? So off to you, sir. I would want to have your anecdote on the question on Ashish ji as well, and then maybe you can add to this.
Ashish ji wala zani, but before that, you mentioned that 10 years and people don't get ESOPs.
Yeah.
So we have a policy, any person with, irrespective of the level in the organization, if he completes 10 years, then we give him 5,000 worth, or let's say about 50-60 lakh worth of an ESOP.
Wow.
Right, so this is the philosophy that if they have worked hard to build this company, they should be rewarded. Right. Okay, now both the question actually, Ashish question and my question is kind of related to one particular event, is that how is the funding environment that you are operating in and how desperate you are, right? Well, I mean, to be saying this in a very crude manner, I'll say beggars are not choosers. I'll start from there, right? But if you have something, you have a real good idea, and this is unique, and there are a couple of investors, then you can negotiate. If you are in a commoditized market with less of a difference, less of a proof of concept, then what will you negotiate? Right? You will say, कि अच्छा जितना भी पैसा आ रहा है, जैसे भी आ रहा है, ले लो. So the art here is that how do you build your story? First the idea, for then the business, as well as what story do you tell? How do you differentiate that you gain at least a negotiation leverage, right? So there can be very difficult kind of clauses that can come your way, right? Right from liquidation preference, board seats, anti-dilution rights, pay as you play, right? Those kind of clauses are really hammer clauses for that matter. It's really difficult. It can choke you in terms of what you do next. So I would suggest that everybody needs fund to grow. But when you go in for the fund, try to always have something in mind that you need something to negotiate on. And you should be different, as well as there should be a reasonable pipeline where you can go and get fund. I'll say that strategic investors are better if they add to your business. They can help you grow than just the financial investors in the early stages. If you can get that, this is wonderful. Otherwise, if same money is available from two investors, then you will try to look at the investor who can understand you, whose philosophy matches with you, whose exit ambitions are like you, and then you see that which one is less problematic for you in future. These clauses or these kind of negotiation doesn't hit you in the first day. It hit you after 3 years, 2 years, when you go for the next round. So you negotiate the agreement not from the perspective of today's funding. You negotiate an agreement from the perspective of second 2 rounds of funding, right? Very important. Otherwise, somewhere, somehow you will have this kind of a problem, drag along kind of rights, which can be really, really difficult.
No, thanks a lot. There's another very important, term which is MFN, most favored nation, which says it's not most favored nation. It's ideally that whenever you will take any investment, we will have the most favored rights. Now, you need to be wary of the facts like this pay to play, which Mandeep ji said wonderfully right. So, thanks a lot to this wonderful panel. Can we have a round of applause, please, for the panel? Anything you people would like to add? Maybe a 30-second anecdote. You're free to give any question you think you want to take up. And, the beautiful thing about the panel was I was able to see nobody stood from their seats. And that's the beauty of the panel, how you stuck everyone on the seats and you let them glued and they couldn't move. So that's wonderful for all of you. A round of applause for everyone. You want to add something, please?
Just one piece of advice for all those people who are looking for some investment. You must have your immediate and 5-year plan ready and rehearsed like the back of your mind. Unless and until you have a bigger vision, you're always going to be found lacking in terms of the prickly question that the investor is going to have. So my piece of advice to you is that you should have a complete vision of where your numbers are today, how you feel those numbers are going to grow, and why would they grow. Now that's a tough task to ask, but I think what you can do is you can probably leverage through other companies. Look, there is enough data in the system wherein you can do that, but at least please make an attempt to have a medium to long term vision available with you in terms of your growth path. Whether it is a product side, whether it is a margin improvement side, whether it is an expansion side, whether it is a cross leverage side, but you must have a long term plan in mind. That's all.
Thanks a lot. Thank you very much. I would like to thank the being a wonderful audience. Thank you very much.